Very often, experienced investors will point to money management as being one of the most important concepts to not only account longevity and profitability, but just survivability in the market. And money management encapsulates concepts like trade size and win-loss ratios and planning your trade and diversification and things like this. But they are very, very important, and there's a couple of reasons for this. In the retail market, traders on average tend to take a lot of risk. So, for example, this statistic is a couple of years old, but I wouldn't imagine that it's changed too much just based on anecdotally what I hear all the time. It used to be that the average Forex account in the U.S. was about $7,000, and that account would trade about 20 times a month, one lot. Now, that's pretty hefty. I mean, imagine that if you're trading one lot every time you're trading 20 times a month, and you got about $7,000 in your account, and let's say you've got a 100 pip stop loss. Well, that's a 17% risk exposure. If you lose that 100 pips, then you're losing 17% of your total portfolio. Now, the problem is that traders will look at this and they'll say, yeah, but if I risk very heavily, if I get a lot of exposure on a per trade basis, then sure, I have some exposure here. But in absolute dollar terms, I have the opportunity to make much more as well per trade. Well, that's true if you're just looking at things on a one trade by one trade basis. The problem is it all breaks down when you start to look at a series of trades. So you're not going to just trade one time and roll the dice. You're going to be trading many times. So what happens is that, let's say, trade number one here, you start out with $10,000, okay? And you're taking a very heavy position and you wind up losing 20% of that $10,000. Well, you now have an $8,000 portfolio. So this is an extreme example, but I think it'll make the point really well. Now, in trade number two, you're starting out with your $8,000, and this time you made 20%. So you had a profitable position here. Now, you're losing and you're winning the same percentage amount, but at this point, you're actually only up to $9,600. So you're still not even at break even. Well, what happens is that the market streaks. This is not a good thing because although trades, so in other words, you don't have an even distribution of your winners versus your losers. You go in streaks. So you'll have a streak of winners. That's always good, but you have a streak of losers as well. And because of the way that this works, your streaks of losers are always more damaging than you may at first realize, and can be more damaging than those streaks of winners. So we have to watch these things really carefully. Well, let's look at an example system. I'm going to show you a couple of screenshots. Now, I picked a profitable system, and we're going to look at the first screenshot here. In this one, I risked 1% of my portfolio. Now, this was based on a Forex pair, but the same thing is true regardless of what market you're trading, especially if you're actively trading. Day trading, swing trading, whatever it is. Now, so I was risking 1% in this particular trade, and over 50 trades. So this was a profitable system. Over 50 trades, I made about 10.5% on the euro dollar. Now, if I up that leverage, so if I up that exposure, the amount that I'm risking per trade, I actually wind up making less. So going to 2%, I actually make 8.26%, and that's because every time I would go on one of those streaks of losers, I would have an even deeper pit to dig myself out of. Similarly, going from 3%, now I'm losing 6.35%. So I'm making less, not only in percentage terms, but in absolute dollar terms by taking a position that's too large. In fact, if I push this all the way up to half of that average exposure that I was talking about before, where we were looking at the $7,000 account, trading 20 times a month, one contract, but if I cut that in half, let's say I'm risking 8%, now all of a sudden, still a profitable system, but now all of a sudden I'm making 3%. So now, the question always is, well, what's the right amount that I should be investing? Well, there's no one right answer to that, unfortunately. What we have to understand is that conceptually, this is what happens. Now, there is a point where you're probably scaling back too light, but for most traders, that's probably quite a lot less than what they're traditionally risking per trade. And just the industry stats that we can see would tell us that the problem is that the brokers are not real active in warning people off about this. They'll talk about win-loss ratios and letting your winners run and such, but they're not big on saying, hey, you should really risk a little amount per trade because they make less for those trades. So they're not as active in talking about that. But the principle is the same. So it's more a matter of getting to know how you trade and playing with that number a little bit, moving it down a little bit, and you'll start to get into a more optimal range that is not only exposing you to less risk, but it's creating a higher return, both in percentage terms as well as in absolute dollar terms.